Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, we get a lot of questions from people, and one of the more recent questions we're getting is, well, where do you think the housing market is going, or where do you think real estate is going? And I thought I'd provide some data and give you some perspective on where we're at, and where we're potentially headed, and also some experts' opinion on the subject. Because as you all know, the asset class, let's call it real estate, particularly residential housing, has really exploded the last few years. Of course, depending on the area of the country you're in, you've seen crazy growth. So let's just dive in. The housing market outlook and perspective. Well, we all know that that interest rates have gone up quite rapidly. And of course, the 30-year rate has just really, let's call it, just about doubled since January, from around 3% to hovering around 6%. We're a little less than 6% right now. But again, according to Bankrate, 30-year rates have really just doubled over the last 7 months. And of course, that is causing a downturn in the housing market. Because as you may recall, housing prices have an inverse relationship to interest rates. And the pace of home price growth decelerated last month because, again, higher borrowing costs. And obviously, the Fed, as you may recall, is really focused on curbing inflation, and it seems to be working. Obviously, home prices have really hurt some people, if they're trying to enter the marketplace. Home prices grew 17%. Or 17.3% year over year in June, according to Black Knight, but down, not that it's a bad thing, but down from a gain of 19.3% in the prior month. And this really marks the third straight month that home prices have slowed, and that 2% decline in growth from May to June marked the largest single month drop on record. Now, one thing to keep in mind, we had a big run up. If you think about March 2020, that's when the financial markets, let's call it bottom. The Fed came out, lowered interest rates, and started printing trillions of dollars and effectively supporting the financial system. They gave it to banks, they gave money to small business owners. Of course, they gave it to the average consumers. So to stabilize the financial markets. So things have dramatically, things then dramatically helped from, let's call it, the quantitative easing, the financial support perspective. And what that did was it created a lot of course, money printing, and investors sought, let's call it, safer havens because, again, the dollar was being devalued. And one of the safe havens was real estate. And obviously, other asset classes like stocks benefited as well. Greatly in the last couple of years. So real estate really shot up quite rapidly the last few years. It's likely not sustainable because residential real estate, depending on where you are, but nationally averages around 3% growth over a long period of time. So of course, this price appreciation is not sustainable. So we're seeing, again, the downturn as a direct result of higher interest rates. And as I noted, real estate is really specific to the area you're in. So if you see certain markets, they've had a pretty decent downturn. Most recently, of course, California, parts of the West Coast has seen some drastic downturn in a quick order, if you will. But so when people say, well, what do you think about the real estate market? Where's the real estate market? It really depends on where you're at in the country. Again, it's not national. What's going on, for example, in New York, what may not necessarily what's going on in Omaha, Nebraska, as an example. Realtor.com, their chief economist Danielle Hale says, well, real estate in terms of price values really depends on a lot of factors, including jobs reports. And her position is if the jobs report is strong, it's likely to spark a new uptick in mortgage rates in anticipation of bigger Fed action. What she's saying is, or at least her belief is, if the jobs report continues to be relatively strong right now, you may recall we're around 3.5% unemployment. Well, if the jobs reports continue to be favorable, that could actually have interest rates continue to move higher, because the belief is that the financial markets, the average consumer can't afford it. By the way, I should note, speaking of affordability, and let's call it cash flow and debt, a report recently came out that discussed that the consumer debt is the highest in history. So something to keep in mind. So folks are putting more and more money on credit cards because it appears cash flow and particularly inflation is really hurting, their pocketbook. So let's move on here. Greg McBride, the chief financial analyst at Bankrate, says until we see sustained evidence that inflation has peaked, there's still a risk that mortgage rates will climb higher. The prospect of the Fed front-loading their interest rate hikes and doing more sooner rather than later may actually help keep a lid on mortgage rates or even bring them down. You may recall, if you watched these videos, last month we talked about peak inflation potentially, let's call it reaching the high last month when we saw gas prices, getting out of control. They've come down quite a bit, and that means other products have likely come down as well. So there's a real chance that peak inflation, at least in the short term, has been capped or maintained. That's good news. I will take good news, especially in today's market environment. He goes on to say that more rate hikes now means fewer rate hikes later. And it means the timetable to peak interest rates get moved up, and it means the eventual decline in interest rates due to a weak economy also happens sooner, says McBride. Well, again, we all know the demand is cooling, of course, as we talked about. Zillow, one of their chief economists or senior economist, Jeff Tucker, says the cooling market, is pushing towards rebalancing its needs, meaning, every asset class has a cycle, a good cycle, meaning where prices appreciate, and a downturn where prices decelerate or decline. And typically, when you get an asset class that is stretched beyond the historical norm in terms of growth, it tends to revert back to the mean. This is healthy, it's normal. I would say it's a good thing. And folks have asked us, where do you think the real estate market's going? And again, I often comment, it depends on where we're talking. Specifically, if you look at like a state like Florida with no state income taxes, very good weather, good, generally speaking, good school districts. I know it depends on where you're at. Low relative crime, folks are continuing to migrate here. So maybe the growth is not likely as sustainable, so the growth probably will just slow like we've seen in other parts of the country. And moving on, and again, demand is cooling. Jeff Tucker says, very expensive markets where home buyers are already on edge when it comes to affordability and therefore more sensitive to mortgage rate changes, in addition to pandemic superstar markets that saw red hot growth during the past few years, are most likely to slow. Notably, I read an article last week that said because the US dollar and the euro are about 1-to-1, there's a lot of folks moving to Europe because housing is a lot more affordable. In fact, 40% of those Americans moving to Europe are actually going to Greece. What a beautiful country. Maybe I'm a little biased for obvious reasons. So again, real estate really depends, meaning the price depends really on where you're at. Here again is a map of the U.S. You could see that there are areas like, so for example, the Southwest that generally are going to see likely a little more growth than, for example, the mid part of the country. The Southeast, for example, even Florida will likely continue to see favorable growth, as noted earlier. So again, real estate really depends, and the prospects for growth depends on where you're at. Again, this is according to Fortune. Zillow's forecast for the end of the year, you can see, year-over-year change and the price, according to the Case-Shiller Index. Zillow's price forecast for growth is still around 16% to the end of the year. So take that for what it's worth. the experts compile their data and they do their best guess to estimate where they think prices are headed. So again, I don't think it's a bad thing. Of course, what it does do is it makes the asset class revert back to the mean, which again is a good thing, because usually if you get a big run up, that means the fall, if you will be hard and fast and potentially brutal for some people. All that to say is, if you would like a second opinion on a portfolio or financial situation, you can go on our website. You can click on the second opinion tab here, click on contact us, fill out your information, and one of our advisors will reach out to you, answer your questions. Maybe you have some concerns about the financial markets. Maybe you do have concern about cash flow. Maybe you're nearing retirement and need some guidance on what to do, what kind of investments to own that would be ideal for you. You can go ahead and reach out to us. Thanks again for watching. Bye-bye.